This is Alternative Angles, the Fidelity podcast where we hear from investors about complex strategies outside the realm of conventional stocks and bonds. I'm Steve Rosen, and I'm your host. As young math students, many of us learned prime factorization, the process of breaking down composite numbers into their irreducible building blocks. And while the methods are prescribed, they are also foundational for developing the pattern and relationship recognition we'd later rely upon to navigate uncertainty and solve more complex problems. Discerning direct lenders approach underwriting in much the same way. Before deciding whether to finance a business and on what terms, they break down a credit into its primary exposures. But identifying the risk factors is only the starting point. Ultimately, the investment decision isn't just the output of a model or a checklist. Rather, it's the product of experience and judgment, understanding how those risks interact, which matter most, and how they should shape the size, structure, and pricing of the loan. This distinction has become critical as private credit has expanded. With capital inflows chasing deals, many investors worry that underwriting has become commoditized, leaving lenders as price takers. But in the traditional middle market, transactions generally remain relationship-driven and dominated by bilateral negotiations. In this segment, underwriting is more bespoke and remains a key differentiator. In the prior episode, we heard from David Gato, Fidelity's head of direct lending, who shared his rationale for focusing on the traditional middle market. Joining me today to dissect direct lending and its risks, factor by factor, are two of his colleagues. Therese Icuss is portfolio manager and head of underwriting, and Audie Apple is managing director and head of capital formation. Together, we'll explore what separates thorough underwriting from a standard checklist and why rigorous credit analysis remains a source of edge in the traditional middle market. Therese, Audie, welcome to Alternative Angles. It's great to see you.
Thanks for having us, Steve.
Great to be here, Steve.
Sure. I'm very excited about this episode. And before we get into the more specific questions, I'd love for each of you to give us a synopsis of the story and the era of your careers and how you got to your current roles. And Audie, how about we start with you?
Sure. Well, my whole career has been in asset management, Steve, and it's always been serving in roles that I describe as sort of sitting at the intersection of portfolio management, marketing, and product development. And being able to translate that across functional units and help build the business in that way. It involves, how do you best articulate your story in a way that resonates and is intuitive to investors, and thinking about what investors are trying to solve for. How do they most efficiently access the strategy? And it varies pretty meaningfully across investor types: institutional, insurance companies, public funds, individuals. And so it's fascinating. It's a fair description of what I do here at Fidelity.
Great. And Therese, why don't you tell us about what you've been up to?
Absolutely. So, Steve, as you mentioned, I'm the head of credit, co-portfolio manager, one of 3 IC members for all of the direct lending funds, having co-founded the business with David Gato, the head of direct lending, and Jeff Scott, our other partner, in 2021. My entire career, over 20 years, has been solely focused on credit and investing in middle market companies. First at JP Morgan, where I went through their credit training program, managed a portfolio of middle market junior debt through the GFC with no handoff to workout, which was very formative in how I've built teams, my credit philosophy, and really how I've developed processes over my career. Before joining Fidelity, most recently, I was at Twin Brook, where I was the co-head of underwriting.
Great. And so, Therese, to stay with you, and you had just mentioned that you've been in this space a long time, over 20 years now. You've clearly seen it evolve quite a bit. And so tell us, what are some of the biggest changes that you've seen during your career?
So certainly the growth has been tremendous, and the expansion of the market has really resulted in what we think about as 2 totally different marketplaces. One being the directly syndicated loan market, which is how we describe what is now referred to as the upper mid-market. That's now the average EBITDA over 200 million is really kind of what distinguishes that marketplace. And for the last 10 plus years before recently, upper mid-market was, 50 to 100 million of EBITDA. So that's a very different company. That's a very different credit profile. And so the market's really expanded to address a much larger borrower type, which is very different than the traditional mid-market, which is what the direct lending of olden times has really grown up into. And that was, really what a lot of the capital that's been raised has been raised on the back of traditional mid-market execution and experience through cycles. I think what's happened in the market as so much capital has been attracted to it, it's widening the aperture to lend to larger businesses that used to traditionally access the broadly syndicated loan market. And the idea of a bigger company is less risky, the credit quality is better, and it's really changed kind of the complexion and the character of those deals in terms of structure and loan documentation. These are now very different concepts than kind of what I grew up doing, what I learned in my JP Morgan credit training, where we focused on, structure, appropriate leverage for a given sector, really understanding the underlying cash flows, not just talking about loan to value. And I think that's the other important change that I've seen is, it used to be from a credit investor standpoint, you stayed away from anything that was growing too fast or had too much risk of obsolescence. Where you've seen a ton of growth and now has been brought into the forefront is the expansion of direct lending into sectors that 10 years ago were not really very large, if at all, components of the market. As you think about software, healthcare, these are now much larger components of the market versus 15 years ago when it was industrials, distribution, manufacturing, that was really core to direct lending. So you've seen a big shift in what I believe is just two very different marketplaces than what has built people's track records historically.
Yes, Steve, I think this point Therese makes about sectors is really an important one to unpack a little bit. Just to put this into context, around 30% of private equity-backed M&A activity has been in technology. In the vast majority, almost all of it's been software. The expansion into not only larger companies, but high growth sectors means that the enterprise value multiples, the price the sponsors are paying, is elevated quite meaningfully. So, you can put more leverage in a capital structure, and in that context, the loan to value looks quite attractive. But at the end of the day, direct lending is cash flow lending, and it's too early to tell. But there's certainly some signs of emerging stress there. But whether that's a good bet or not, it's going to take some more time to know if it is.
Okay. Now, Audie, I want to stay with you because you mentioned something about the industries, and Therese, you alluded to that as well, in addition to size. So I want to get at what this evolution in loan size and industry sector that you both referred to means for investors. In and of itself, the fact that larger companies, which may well be resilient credits, are served by the private credit markets seems like a positive development. And with additional industries included, that's just more choices. You have bigger companies, more industries, more opportunity for lenders, and in turn, more opportunity for borrowers. So on the surface, that seems good. So why isn't this widening of the opportunity set good all around?
Well, I think, Steve, more options for borrowers is always a good thing from their perspective. From lenders, it should mean a wider funnel, and generally it should be a good thing as well. But if that expansion of the opportunity set has lenders looking at deals that have optionality to finance the transaction in liquid markets like the broadly syndicated loan market, now you have an incremental challenge added to the mix, and that is maintaining the same level of underwriting and structural discipline when you're competing with a capital source that's less expensive and is structurally cov-light. And so, I think this has largely been done on the basis, the rationale that Therese mentioned, that larger borrowers are safer credits, which sort of implicitly suggests that you're going to get a better investment outcome. But, the data actually contradicts that. If you look at the data, the traditional middle market historically has produced slightly higher returns after defaults and recoveries. So, net of any incremental risk when compared to the largest borrowers served by direct lenders. And if you take a step further and more granular look at the dispersion of returns in those two respective segments of the market, the dispersion, a proxy for risk, is actually smaller, narrower in the traditional middle market than it is in the upper middle market. So clearly a contradiction to the narrative that often prevails out there that these larger borrowers are safer credits. What for us, it's a clear signal that any potential risk mitigating benefit associated with scale is being negotiated away in the form of lower spreads, higher leverage, and looser documents.
Yeah, and I think it's absolutely good for companies, the economy, that there is expanded credit sources available to larger companies, and they can utilize the private markets, especially in times of turbulence, to there's a lot of value to a company to operate in the private markets, from what your customers know, what your suppliers know, if you are undergoing any challenges. And I think they're usually willing to pay for that. And so I think it's very good overall that companies have access to this asset class. But I think what investors need to just be mindful of is what are we giving up in terms of accessing that part of the market today versus what's being represented in terms of what historically direct lending has afforded investors from a default rate and risk profile. I think parsing through that is much more challenging for an allocator today than it used to be when you just talked about lower core and upper mid-market. I think the underlying execution is really what needs to be unpacked in order to understand kind of, can we expect the historical returns to predict the future?
Okay, well, you use the word unpack. So let's stay with that. And how about if you unpack or walk us through, the nuts and bolts of a traditional middle market execution?
Yeah, for us, this means a couple things, and it's really critical to our process. One is just access. So we are really focused on providing feedback based on our own internal proprietary diligence. And in order to do that, we need access to management, we need access to the sponsor, and we need time to do our work. Our processes are 30 to 90 days. This is not like a broadly syndicated loan execution where you're handed a marketing book and here's the structure, let us know next week what your desired hold is or what you'd like to buy. This is very iterative to have engagement with the sponsor, with the management team, and time to do our own thorough diligence to arrive at what do we think is the right structure for a given business, and can we get behind the credit itself. And I think that, on the structure point, really it's what is the appropriate leverage for a business, not just what is the market willing to afford a given company, but what do we think is the right leverage profile for a business, and what does that mean for the time that we spend on an asset. It might be that we think leverage should be lower, the market's willing to provide more, it's probably just not the right fit for us. Beyond just the leverage and the presence of a financial covenant, it's what does that underlying covenant really provide? What is the level at which we'll be back at the table in order to reassess the risk and potentially reprice the risk based on divergence from what we expected when we closed the initial transaction as an acceptable change in performance. That's really critical. And so the covenant levels, are there step downs in the covenant levels? What are the definitions behind the covenants? How adjusted can EBITDA be? And so those are the key things that our team spends a ton of time on. And then beyond that, the documentation itself, I mean, this has come out certainly more in recent past of just really understanding what collateral protections do you have. And if we're truly first lien senior secured, we should be locked down in terms of the collateral protections that we have, what the business can do without having to come back to us in terms of asset sales, distributions. And these are all bespoke to each deal and negotiated heavily, but those are things that we believe are imperative to recoveries and over time being able to price the risk appropriately. We focus on interest coverage. This is not something new. We've focused on this even before the rate hikes started. Our senior team is largely bank credit trained. We grew up focusing on calculating fixed charge coverage and interest coverage, and are we putting too much leverage on a business? Can the existing cash flows without any growth support the debt that's being put on the business? We believe leverage is the number one killer of businesses. And so really getting behind that and arriving at a structure that works for the sponsor, that works for us in a more fragmented, market, we think allows us to, build a portfolio that is diverse. And yes, the company's the size of the company might be what someone traditionally would have called, lower or core mid-market, but all of the protections around it and the structure, we think with a diversified portfolio provides really attractive risk return consistent with what, direct lending has been able to produce for investors over time.
Therese mentions an important point about, enterprise value, right? On these high growth sectors where the sponsor's paying a high enterprise value multiple, at origination, your loan to value can look very attractive, but you're paying a high multiple because your expected growth rate in those earnings are quite elevated, right? The moment that growth rate is called into question, or even worse, perhaps rolls over, then what was a 40% loan to value transaction at origination can quickly become an 80% loan to value loan or worse. That changes very quickly. It's really the metric that matters is leverage expressed as debt as a multiple of the earnings of the company. That's what is really driving this. And then, the other part of what she spoke about was, these structures. These are key elements, and they're so misunderstood in the market. I think, so many times payment defaults are conflated with covenant defaults. Well, covenant defaults properly designed are intended to be default early, long before there's risk of capital impairment. And that allows you to bring the borrower back to the table, as Therese referenced. I think a directional guide of what you might experience as Cov-Lite continues to proliferate in the larger segment of the market is what we've seen in the broadly syndicated loan market. Over the last 10 to 15 years, that's gone from a market where you still had most loans with covenants to a structurally Cov-Lite market. Over that same period, recoveries on loans that had a payment default is down by more than half. And with an asset class like credit, how much you recover on troubled credits is a tremendously important metric because that's just part of the business. Not every loan is going to perform perfectly.
All right. So Audie, as you mentioned some progression in various credit metrics over time, which tells me that a track record of a lender could be a tricky thing to rely upon because, the means by which we're evaluating them are different given the circumstances in the market today versus in the past. So how should allocators conducting diligence on a manager distinguish between those who really do have value to add versus those that might be well marketed based upon statistics that aren't necessarily applicable in the market today?
This question reminds me of the old famous Keynes quote, well, when the facts change, I change my mind, sir. What do you do? Right? So if there's been a meaningful evolution or change in the character of the structures, the loan documentation, et cetera, that a manager's producing today in their portfolio versus what those looked like in the track record historically, then you really have to ask yourself the question, how much should one rely on the track record as a predictor of what's going to happen going forward? You know, there's the old adage, you can't buy past performance, and certainly not when things are changing structurally. And so what do you do about that? How do you see past that? Well, you've got to get really granular detail. I think, you know, private markets are infamous for opaqueness, right? Well, there's increasing transparency coming not only to private credit, but also private markets in general. And investors need to get detailed in the questions. A key point Therese made is, you know, how do you calibrate those covenants? Are they tight enough that they're going to be tripped while there's still meaningful enterprise value? So asking on a loan tape, is there a covenant or not? Yes or no? It's not binary. You really got to dig deeper than that. You want to know closing leverage and current leverage. Where are those covenants calibrated? There's just a lot of detail. And if you get it, you can begin to see a pattern, and you can see to what extent things have changed for that manager and for the asset class overall. And lastly, I'd mention that, you know, valuation is very much in the forefront in media coverage in the space right now. And there's a fair amount of variance in how managers approach valuation. With the proliferation of evergreen vehicles, you really want to understand what their policy is and how it's executed.
That's a really good point, Audie. I mean, valuation is one area that we've sought to provide a level of transparency that we think is unique, in that we do have a third party value every single one of our loans every single month. That is telling our investors, I think, the health of the portfolio over time. And what really matters is getting the money back versus kind of where the mark might be at a point in time. But, you know, I think what that does is make the playing field level in terms of we're not grading our own tests. There is a third party that's looking at our portfolio every single month and providing an assessment, a range of values. And we have a fair value committee within Fidelity that is not comprised of anybody on the investment team. And so I think that, you know, we've been a little bit ahead of the curve. There's been a lot of talk now on valuation and marks changing very dramatically quarter to quarter. And, you know, we've sought to, you know, for years now, we've sought to provide that level of transparency on a monthly basis, you know, which we think is unique.
Okay. Now, Therese, I want to move to maybe competitive set and how you're differentiated. There are plenty of competitors out there that are focusing on the traditional middle market. And I imagine that many of them came from the old days, as you referred to, from the commercial finance businesses that were located in Chicago. And I assume some of those competitors today are near you. But you must feel that your underwriting process is different. You offer sponsors and investors a differentiated approach and presumably an edge. So why don't you walk us through your underwriting process at Fidelity from your initial review through closing a loan?
Absolutely. And yeah, there definitely is not a lack of lenders, and especially here in Chicago, focused on the traditional mid-market. And because of, you know, the somewhat benign environment we've had overall, despite some of the spikes in volatility, you know, we have lived through a very benign environment for the last, you know, over 15 years. And so I think the dispersion is what a lot of folks have been looking for. And it's harder when you don't have, as we talked about, kind of the change in the market, the track records going through a cycle. It's hard to point to what makes a group unique, and everybody is going to say why they're unique. For us, it really comes down to the consistency in our process and the independence in our process, and what we like to describe as the Fidelity halo in everything that we do. And when I joined, I thought this was going to be a marketing shtick. I didn't know how much value we would really get from a risk perspective. And I can say that it is game changing. Having been in this space, having been at different companies that obviously are very successful, the information and insights that we have available in our process is unlike anything that I've ever had the benefit of. And as a risk person, you know, overseeing a large portfolio, it does really help for us to have that information advantage and be able to walk away from potential trickier situations, and to use our time where we have more insights, where we can gain more conviction. And I think overall, from an investor standpoint, that's really what we're here to do. We're here to avoid making a bad loan. I mean, I think those are some of your best loans, right? As you avoid making a bad loan. And, we've not only used the Fidelity research analysts, which we have nearly 500 research analysts across fixed income, equity, high income, that treat our team just like any other portfolio management team. And so we're on the phone with the relevant analysts as we're looking at every investment opportunity. And what those analysts are providing us is, our team is doing all the credit analysis, the credit work to determine the viability of, an investment for the benefit of our team. But those analysts are oftentimes covering the customers, the competitors, the suppliers that are working with our, potential issuer. And what they're providing us is insights into, how the industry might be changing around our niche company. What are the customers thinking about in relation to buying or the product or service our issuer might be providing? What are the competitors doing, the larger competitors that are presumably, have more scale? What are they doing in the space that could impact our borrowers? And these are really differentiated insights compared to looking at the industry study that the private equity sponsor is going to commission and provide to us, which we value and we review, and that's great. But that is commissioned for the sponsor for their benefit to make an equity investment. We're not equity investors, we're debt investors. And so we have to think about the downside differently. And, in 20 years, I think I've read one industry study from a sponsor that was negative. And I have gotten industry studies where entire pages and sections are just omitted. And so you're led to water because the sponsor is already bought in on making an investment in a given company. And so what we're bringing to our investors is independence and a view on the industry that the company is going to operate in based on real-time information and experts that are meeting with public company CEOs, meeting with our company's competitors. And it's not just the research analysts. We're also able to work with all of our colleagues across different divisions to gain valuable insights. When you think about software, which is obviously a very hot topic of late, Fidelity procurement engages with over 1,200 unique software providers, which means we've RFP'd multiples of that. And so any software company we look at, we are talking to our procurement team to say, and we're not sharing confidential information, but we're saying, this is the type of business that we're looking at. These are the services that they're providing. Do we use something like this? Who did we evaluate? Why did we go with the provider we did? And that's providing us really unique insights that our competitors don't have. And I'll give you a real-time example. We recently had a business that provided data analytics and historical information that hedge funds, asset managers, other financial institutions utilize, including Fidelity utilized. And all of the customer call notes, the industry study, even our third-party checks that we did with other hedge funds were extremely positive on this business. I mean, glowing. And you look at that body of work and say, this is a no-brainer debt investment. We talked to our internal Fidelity strategy team. They had already developed a product that allowed one of our teams of 17 that utilized this particular vendor to cancel the subscription. We developed our own in-house tool that did exactly the same thing. And so to us, it's avoiding making those loans where the risk is beyond what we should be taking as a debt investor. That's a real win in my book. And we shared that information with the sponsor. We understand that they pursued the investment. They had other lenders that were very excited about the credit, and that's great. And I hope they're very successful. But for us to be able to avoid a potential pitfall, is a huge advantage. And so we use that Fidelity edge in everything that we do.
Yeah, Steve, if you think about what Therese is saying, it's not only helping us make more informed decisions, it's become part of the value proposition to the sponsors. The sponsors well understand that the vast majority of their companies don't have that perfect linear up to the right performance experience. They have challenges to varying degrees. And if you as a lender can demonstrate a true and complete understanding of the key performance drivers, potential headwinds, then you become a constructive counterparty. And that adds real value. That's what they're looking for. If you can add that, then you're not forced to compete purely on price and loose structure. If you can be viewed as having that constructive perspective, orthogonal point of view on their platforms, then you're in a much better position to win.
Interesting. I like the use of the word orthogonal there. You get credit for that. But to challenge you a little bit, as you scale up, and how it must be challenging to stick to traditional middle market execution and avoid a commoditized underwriting process. And does that hamstring your ability to grow and limit your opportunity set, or do you have a plan for that?
Yeah, I think it definitely is challenging, and you see so many groups that have success begets success. You raise more capital, and so many groups have moved up market. And I think, for us, since we started the business, culture and consistency in process and incentives have really been the cornerstone of how we operate. And I think that is truly the key to avoid commoditization. I mean, it's a choice, right? It's a choice to move up market. It's a choice to compete on price alone or on structure. And so it's maintaining that discipline. And I think it starts in everything we do. I mean, our hiring process, since we started, everyone that's been hired has gone through a detailed 3-hour assessment, even if we had worked with them before. And if they, pass that assessment, which is really us trying to understand how people think. It's not build me an LBO model and tell me if you would invest in this credit. It's really, how do you think? How do you operate under stress? And how are you curious? And, people that go through that assessment, and when we started the business, I think I interviewed myself over 150 people, to hire, a handful at the time. If you make it through that assessment, even if you get an A+ on that, so to speak, you have to come in and meet the team, and we have to, determine, are you going to think like an owner? Are you going to, want to make those around you better? Are you going to take, be accountable for the business and really want to be a part of something bigger than yourself and celebrate each other's successes versus individuals? I think those are all really critical. I think about even the people that we hired at the senior level, we had them develop business plans before they came in to interview. People that I had worked with for 15 years, I said, develop a business plan and tell me what you're going to bring to our team and why we should hire you. So I think that discipline in everything from hiring, the little things add up and help us avoid, those types of pitfalls. But I do think the incentives really matter. And a big part of my attraction to the Fidelity opportunity was when I spoke with Bart Grenier, the head of asset management. Part of my interview process, his message was, you don't work for the private equity sponsors. And I'd rather you avoid making bad loans than grow for the sake of growth. And that's a very powerful message and a very powerful tone from leadership that allows us to go into every investment decision of, am I going to be proud for this to be in the portfolio versus, am I going to hit my sales target? And, we're compensated based on 3-5 year performance of the funds, not based on how much AUM did we add. scale in lending can truly be a liability. And I think people talk about scaled providers are going to prevail and the smaller ones, won't necessarily win the day. I think for us, we have the benefit of scale being a part of a $7 trillion asset manager, from compliance, legal, tax, operations, resources, research, all of the benefits of scale that an investor should want. But we also have the nimbleness of focusing on the traditional mid-market and not being incentivized just to grow. And so I think that also allows us to be a really stable and consistent partner to our PE sponsors.
Yeah, Steve, Therese mentioned something I think is worth elaborating on, and that is being very deliberate about raising capital. Like in the last 5 years, I mentioned access vehicles. There's been this innovation of the subscription-based BDC for the wealth channel, and that has grown from zero in 2020 to over $300 billion in these vehicles. It's close to 40% of the growth in the asset class since its launch in 2021, roughly. It really does change the game. Investing I've heard described as playing a game of baseball with no called strikes. You get to sit in the batter's box and wait until the perfect pitch comes, and then you swing, okay? And all of the capital historically to invest in direct lending has been in drawdown vehicles, and that's exactly what the investment teams have been able to do. Now, when you introduce a subscription vehicle, you're changing the dynamics meaningfully. You've got to have enough quality deal flow to match the level of capital that's coming in, you're accepting on a monthly basis. And so if you think about it in the context of the metaphor that I've used, now not only are strikes being called, but you've got a shot clock running as well. So, you have to just think that through and understand that has a profound impact on the negotiating dynamics between the lender and the borrower. And I think that's an important element for people to understand.
I love the sports analogy, Audie. I think it's interesting. We've had so much focus from our PE sponsors recently, asking about our investor base, how much retail capital we have, what our redemptions have been, questions that we would not have ever gotten, 6 to 12 months ago. And we are really proud of our approach and how deliberate we've been in ensuring the investor base is scaling to kind of the front end of our business, and also that we're taking the time to make sure our clients are very educated as to what it means to be in a perpetual non-traded direct lending vehicle from a liquidity standpoint. And I think it's not over yet, but comparatively, we're very proud of kind of how we've performed in that vehicle over the last several quarters. And I think to your point, Audie, it's just from the top down, it's been a very deliberate focus on not looking to just raise as much capital as possible, but let's do this in a prudent way so that we have a long-term, very resilient, durable business that we're proud of.
Okay, great. We're getting close to the end of the session, but I want to throw in another question and veer from what we've talked about heretofore, which is a lot about the origination, and instead focus or shift to portfolio monitoring. So talk us through the portfolio monitoring process from post-close through the life of the loan. Maybe Therese, you could handle this one and tell us, was there a situation where you worked with a borrower to achieve a better outcome? And conversely, what are the early warning signs that matter most? And can you speak to a credit that might have gone sideways and that you had to step in and handle it?
Absolutely. So I think, the portfolio management side of our business, I tell the team, is the most important part of our role as investors. This is a very high touch business, and we're working very closely with our companies and with the sponsors to understand the underlying trends, understand their strategy, the challenges that they might have. And the more that we are in tune with that, and the more we understand the businesses and the potential risks or the underlying drivers of performance, we're able to be better partners. We can be more proactive versus reactive. And so, early warning signs, I think what we look to do is provide the revolving line of credit for a majority of our companies. And we built out the infrastructure here at Fidelity to do that. That really gives us a sign, even before we get the monthly financials, of how is the company performing? Why are they drawing on the revolver? Is there a change in the profitability? Is there an increased working capital requirement? Did they lose a customer? Like, we're able to use that to better understand what's going on at the business on an ongoing basis. I've had a lot of situations in my career where, things, as Audie said, don't always go up and to the right. But one that sticks out, recently, we had a business, that was a sizable business. It had grown, made several acquisitions while we had invested in it, and ultimately had an ERP implementation that was very challenging in a seasonal time for the business that was critical. And then we had weather conditions that kind of really impacted the business as well. And because we were the agent in that transaction, because we had covenants that were set well inside the enterprise value, and before the company had a liquidity problem, we were back at the table with the sponsor and able to really partner with them hand in hand, get a consultant involved. They supported the business with additional equity, significant incremental equity on top of the equity they had invested in the company. And with our nudging as a first lien lender and the covenants that we had, they came to the conclusion, that it was best for them to look to exit the business. They had several strategics that were interested in the company. And I think that's the other secret that people leave out about, bigger companies are better. I think for, businesses that are in that lower core mid-market, there's often lots of ways out in terms of strategics that find those businesses as attractive add-ons. And in this case, they ultimately sold one division of the business to a strategic for a multiple that resulted in us being fully repaid on our loan, and still significant value remaining in the company that the sponsor, continued to have ownership of. And so, that there's a lot that goes behind that in terms of the art of partnering with the sponsor, getting to the right place, making sure that your concerns and desires and strategy are known to the sponsor, and kind of allowing them to take that information to get to a place where, we want it to be a good outcome for everyone. We certainly want to get our investors' money back, but we, at the end of the day, these are people that we partner with, that we value, that are good partners to us. We want them to have good outcomes as well. I think the other thing that is important to understand, like, in addition to structure and role really mattering in that particular case, we do have deep workout experience on our team. And that doesn't mean that it's because we do a lot of bad deals, but if you're in this business for a long enough time, you're going to, at scale, have problems. And it's really how you work through those. And we're generally working to get to an outcome where you're selling the business in parts or in whole, in partnership with the sponsor, that results in, the best outcome for everybody. And I think that there is an art to that, but certainly, over the deals that we've collectively done across our team, that's really indicative of our track record and our experience.
Okay, great. Well, this has been a wonderful discussion. I've learned a bunch from both of you. So, Therese, Audie, thanks so much for dropping into Alternative Angles.
Thanks, Steve. Loved it. If we can do it again, I'll be sure and have some fancy words lined up.
Thank you so much, Steve. Great to be here.
This podcast is intended for institutional investor and investment professionals only. Information presented herein is for discussion and illustrative purposes only, and is not a recommendation or an offer or a solicitation to buy or sell any securities. Views expressed are as of August 2026, based on the information available at that time, and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Unless otherwise expressly disclosed to you in writing, the information provided in this material is for educational purposes only. Any viewpoints expressed by Fidelity are not intended to be used as a primary basis for your investment decisions and are based on facts and circumstances at the point in time they are made and are not particular to you. Accordingly, nothing in this material constitutes impartial investment advice or advice in a fiduciary capacity, as defined or under the Employee Retirement Income Security Act of 1974 or the Internal Revenue Code of 1986, both as amended. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in this material because they have a financial interest in the products or services and may receive compensation, directly or indirectly, in connection with the management, distribution, and/or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Before making any investment decisions, you should take into account all of the particular facts and circumstances of you or your client's individual situation and reach out to an investment professional, if applicable. References to specific companies or investment themes are for illustrative purposes only and should not be construed as recommendations or investment advice. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. The securities mentioned are for illustrative purposes only and not necessarily current holdings invested by FMR LLC. References to specific issuers or securities should not be construed as recommendations or investment advice. This piece may contain assumptions that are forward-looking statements, which are based on certain assumptions of future events. Actual events are difficult to predict and may differ from those assumed. There can be no assurance that forward-looking statements will materialize or that actual returns or results will not be materially different from those described here. Alternative investments are investment products other than the traditional investments of stocks, bonds, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments are alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Costs of purchase and sale may be relatively high. Stock markets, especially foreign markets, are volatile and can decline significantly in response to adverse issuer, political, regulatory, market, or economic developments. Foreign securities are subject to interest rate, currency exchange rate, economic, and political risks. Securities selected using quantitative analysis can perform differently from the market as a whole as a result of the factors used in the analysis, the weight placed on each factor, and changes in the factor's historical trends. Securities lending involves the risk that the borrower may fail to return the securities loaned in a timely manner or at all. If the borrower defaults on its obligation to return the securities loaned because of insolvency or other reasons, a fund could experience delays and costs in recovering the securities loaned or in gaining access to the collateral. Past performance is no guarantee of future results. Investing involves risk, including risk of loss. Fidelity Investments provides investment products through Fidelity Distributors Company, LLC, clearing, custody, or other brokerage services through National Financial Services, LLC, or Fidelity Brokerage Services, LLC, members NYSE, SIPC, and institutional advisory services through Fidelity. Institutional Wealth Advisor, LLC. Copyright 2026 FMR LLC. All rights reserved.